Good morning, everyone. So we are going to be jumping into our chapter 20 today. I have asked for you to have a couple of files ready to go because as I work on this chapter, we're going to be opening those and adding a few things to them here and there. But I did want to start today with a quick review of the chapter problems for 19.3 and 19.4. Just a reminder, we will be doing the earlier ones. We're doing 19.1 and 19.2. after we do the next class, which is chapter 21, so that you can actually learn how to enter the slips properly rather than sort of kind of cobbling them together and maybe not learning them the right way. So we'll be coming back to those ones, but we're going to be doing chapter 19.3 and 19.4 today. So what I will do now is just share my screen really quickly, see what comes up on it. Pull a few things off to the side here. And I'm also going to pull up the answers for chapter 19. So just a quick reminder there, what those answers were. And the first file that we were doing were Richard and Catherine Tenenbaum. And so the last thing I'm going to do is pull up a copy of the textbook, and we're going to go from here. Just a refresher on this practice case, we have the Tenenbaums. Richard is a systems analyst. Catherine has not been working. She had an accident. She does not have a disability, but she has an infirmity. We have some medical expenses, and we have some donations. So this is one where you have to decide, first of all, how many tax returns you're going to be preparing. And remember that when you're putting tax returns in the computer, it doesn't necessarily mean you're going to be filing it, but you have to decide, are you setting up one return or two? So the first question that I wanted to ask is, in the chat window, which did you think was the best way to do the data entry for this case? To do one file for Richard and then related party spouse not processed, or would you recommend setting up two files, one for each of them that are joined? So if you could let me know in the chat window what your preference was, and to see if we come to the same agreement. You did the problem. What did you decide to do? So Helene, you did two files. Okay, let's see if we get a few more people. Connie, two files as well. Excellent. So I do recommend in this case that you do two files. It is technically possible to do this using related party spouse not processed. That being said, when you do that, you have to know your tax return and your dependent credits inside out and backwards. You have to be really, really, really confident, not only in the federal credits and how they are transferred, but also in the provincial credits and what applies and what doesn't. When you do the two files, the computer will make optimizations and it will do the best results. When you only have one, you have to pre-select what you want the credits to be and then make sure that they have worked appropriately. So I would say, even after all the years that I've done tax returns, unless there was a reason why I absolutely could not do two files, maybe Catherine says, I refuse to let you open a file for me. I don't want my personal information in your computers. Minimum things we need to have a net income figure and a SIN number, and she doesn't want anything else being collected by the company. In that circumstances, my hands are tied and I have to make it work. I would have to then advise the client that I'm going to do my best to give you the best possible result, but I can't guarantee that it is going to be the best possible result. When you have one with this, even if there is no actual transfer happening, it is always best practices to do two files in this case. And then you can close one of them. If she's not going to file a return, don't file a return. You don't have to file a return just because you've created one. Okay, so we're going to set up two files. I will show you at the end of doing this what it would look like to do one file. It is possible to do, but again, really only do that after you have ruled out all of your provincial information as well. Just one quick pause here while I switch over. I think we've got our technical problems working now. So as I go, oh, getting a little echo. Perfect. So as I go through now, I'm going to take a look at what we're going to include on there. So we have prescriptions, a whole number of them, and we have a receipt for September 30th, 2020. What recommendation do you have for that 2020 September 30th receipt? So just a reminder, if we're going to change medical last date for any reason, the latest date we could claim, if we want to get the September 30th receipt, the latest date we could claim in the next year would be September 29th, which would rule out all of these. Okay, Anna Marie, so your advice is forget it. I agree. I would tell the client, I can't use that receipt. We're not going to. It will be wasted. That's fine. That happens all the time. It is better to get the larger amount this year. So you're going to give that receipt back to the client. Tell her to put it in her 2020 tax file. You never know if something else will come up that she'd forgotten and we can do an adjustment then, but we don't need to keep track of that and it isn't going to be used. It is more beneficial to claim the larger receipts. Excellent. Getting into the habit of the fact that you don't always put everything on a tax return just because you have it. Okay, and then we are going to be doing a little bit of income, always double checking on T4s now, making sure you're looking for things like donations, things like box 85s for additional medical expenses, but we didn't have any here. So I'm going to open up the Tenenbaum file that I have created, and that is this one here. And this is the one that I would have expected you to do, which is to say nice, comfortable data entry with 2 files. And what I would like to point out as well is my best practices keep the receipts for the person who paid for them. So even though we know that medical expenses are going to be claimed on Richard's file, you should still enter them. If you're doing 2 files, enter them on the person for whom the expenses were paid, because it's going to make sure that you're putting everything accurately on the right line. So make that the habit for you. It saves those last minute mistakes. The results would have been the same if I had entered them on Richard's. So if I had put them on Richard's, it wouldn't have made a difference in the computer. But it's not the best practices, because what will happen in an office is you get into the habit of just going, I'm going to claim all the medical expenses by the family head and do that. And then you're going to forget that one of those receipts was actually for an adult dependent and it should have been on line 33199, and you haven't thought about that because you were going quickly. So always, always, always put them on the data entry for the person who is actually paying or is actually getting the medical treatment. Okay. Cannot stress enough how many mistakes I have caught from young associates in an office or new associates in an office who have gotten into the habit of just lumping everything together and doing the data entry on one person without realizing that there was an expectation it has to go somewhere else. So make it your practice. I cannot stress this enough. You can get the right answer in the wrong way. And the problem is, if you do that one time, it's going to be the wrong answer because you weren't being careful with who the expenses were paid for. So I'm not going to say you necessarily would have lost marks, but I do want you practicing to do it in the way that is going to make your returns accurate when you have to do a lot of them very quickly. So I have put all of Catherine's medical expenses on her file because they were her expenses. And then when we go to the tax return, we will generate a tax return for Catherine, but just a reminder, she doesn't need to file one. And vowing a dependent's medical expenses go on the dependent's file, and that one's even extra important. So spouses will always share their own expenses. So spouses, if you put it on the wrong file, it's going to go to the right place. Dependents are the one where people get caught because we have children linked to files. And when we have children linked to files, we don't always double check their ages. So if we put all of the family's expenses on the family head, we might have forgotten that one of those children is actually 19 or 20 or 21 and they're in university, and their dependent expenses should have been on theirs because it goes on line 33199. If you put it in the right place, the computer will also put it in the right place. If you don't think about it, those are really easy mistakes to make. So Just a reminder, Catherine doesn't have a need to file a return. I do want to make sure that you did include no income. If you didn't say no income, if I had taken that out and I had not done it, let's see if it will put the warning up for me. It should give me an e-file error. It will not let me file a return with no income if I haven't said I really meant for that to be no income. Brittany has a question. When a child grows up and moves out, becomes their own family head, how can we unlink them? You will be learning that when I teach you how to do family separations. So we do have a method for doing that. It does happen eventually for some of our families that have been with us for a long time. We're going to learn how to separate people, not just children from families, but also married people who are no longer married, how to separate those files as well. So there is a way to do that, and I will teach you that in a chapter or two. I think it's chapter 22, but don't quote me on that. I haven't worked that far ahead. All right, so just a quick reminder, always check your notes and diagnostics. What you might do if you're doing Catherine's and you have a wasted receipt is you might make a note that is carry forward note and say you have a receipt that you didn't use and why you didn't use it. So not 100% necessary. You're not going to get marked on having that note, but it's going to make your life easier as someone who works in what we call the off season, someone who works in the summers and the falls. When you have a client coming back going, why didn't you claim my receipt? I had a receipt. I brought it to you. You didn't use it. Rather than me looking at the file and having to figure out why I didn't claim it, and I may not have all the dates for those receipts later on if I've done a summary at the bottom, I can just look at my notes and go, oh yeah, no, we looked at that receipt and we decided we couldn't use it and this is why. And then you have solved the problem without having to do any extra work. So I'm going to go back into Catherine now. I'm going to fix my e-file error and I'm going to say yes, no income. So now we have a clear file here with no problems. For Richard, we're going to have a nice big refund. So what I would like to do now is ask you in the chat window to explain the refund for me. So I gave you a number of notes that I wanted to see. Let's see if you came up with the same notes that I did. What is the reason that Richard has a refund over $500? Okay, so there was an infirmity. I would usually specify the actual credit we're giving them to make it clear. So caregiver amount is what we're going to say. So caregiver amount will be one reason. What's another one? Okay, did she have a disability or just an infirmity? Okay, medical is one for sure. Donations. See if we've got all of them. Registered pension plan. Right, very good. So we have RPP. I like to do them in the order on the tax return so that I don't miss any. I start, if I'm doing a refund, I start with my deductions. My deductions are my registered pension plan. Then I go to credits. Credits, we have a spousal amount plus a caregiver amount. For my notes, and again, this is just from being in an office for a long time and needing to be able to find the information quickly, I will say caregiver, whose caregiver, because you could have more than one caregiver amount. If they had had a child with an infirmity, you would have two caregiver amounts, and then I would have to have two notes. Like caregiver for spouse, medical expenses, donations. Helene, where's the note put? I will use data entry notes annual for that. So if I went in and I found my notes section, I'm going to have notes dash annual. That will put it on the top of my notes and diagnostics, but just connect it to the 2021 tax year. That means I'm not going to see it next year when I open it because it's not relevant to the 2022 return, but it's going to be there if I have to go back and explain the refund later. So what I am expecting to see is RPP, spousal amount, caregiver for spouse, or caregiver will be fine, medical expenses, and donations. Okay. I think that is all the questions that I had on that one. Check marks. We need to make sure we have enough check marks. There should be one on the T4, and that's it. And my last question, I think we did already, which is, oh no, why is Richard not receiving a caregiver amount for Catherine on his provincial credits? I wanted you to take a look at the provincial credits because we forget to do that when we do these. So if we're looking at these, we're going to go in here, we're going to see we have a spousal amount. We're going to keep going down. There's no infirm dependent age 18 or older. And we're going to keep going down, and there's no caregiver amount. Why is there no caregiver amount? And Maurice, I'll answer that question in a minute. Let's do this one first. So why is there no caregiver amount provincially? Because spouses are not eligible. Perfect. That's the note that I wanted you to remember. Your computer is going to make decisions. You have to decide if those decisions are correct. This is a really, really good opportunity as you're doing these problems to make sure you're getting comfortable with the provincial forms as well. If the computer is doing something, you want to make sure you understand why the computer is doing that thing. So this is a good opportunity to see the provincial forms, trust that they're probably right, and then use that to help solidify that portion of your understanding. So a couple of questions here. Helene says, when I say 5 notes, I mean 5 things in one note. Yes, I want 5 reasons within one note. And then Marisa says, is it wrong if you put more check marks? Yes, you shouldn't put check marks you don't need, only because it makes life complicated in order of making sure if you put check marks on every single line, then when you look back at your data entry, it gets very busy and it's hard to understand. So what we want to make sure is that you have standard across the board. We're all doing the same thing. I would say in an actual office, if you're working on your own file, put check marks wherever you want check marks to be, plus any needed to clear your warnings. But for the purposes of the course, because we're going to mark you on how many check marks you have, I want to make sure we're all doing it the same way. So I will tell you precisely how many check marks I want, and that will be the minimum number that is required, and that's what we're going to test you on, so it's good to practice. All right, I did say I would show you that it is possible to do this in exact result using only one file. So it is possible to do Richard with a return of spouse not processed. In order to do that, the data entry is actually fairly simple for this case. You're going to put Catherine's information in. You're going to put Catherine's net income as 0. And there is a button on related party for caregiver, yes. However, before I can do that, I have to understand precisely what I am doing with caregiver, with spousal transfers, with provincial credits, because you need to make sure that provincial credits don't apply to whichever spouse you're connecting. There may have been other things that could have happened. We'll see that in later practice problems, which would have been more difficult to work this way. If there had been Canada Workers Benefit, you have to adjust for that in this section. There are a number of things you can do, but you really have to know your tax return and be confident you're not missing anything and you're not adding anything you shouldn't be. So step 1 would be go through the return, essentially do them by hand until you know what you're expecting to see on Richard's return, then get the data entry to look like that. And then, of course, you do, in that case, have to put all of the donations and the medical on one, but that requires you to know for a fact that they are being transferred to the right person. So you can do it. I wouldn't. If I was in an office, the only time I would do this is if I had no other way of doing the tax return. In an office, I would definitely be doing it with 2 files. All right, now when you do with 2 files and you know that Catherine isn't going to file return, you have the option of closing her file. So in an actual office setting, Richards would now say ready to e-file, and I would have him sign all of his paperwork. Then I would go into Catherine's, and because I don't want to leave it sitting there saying, please e-file me, and wonder why I haven't done it, I would then go into my status information, and I would say file closed, and I would say client elected not to file. Something like that. Maybe why she didn't file, no benefit of filing a return, put a note somewhere, and then you can close the file, and when you say OK, it'll say file closed. So that way, I'm keeping track in the computer that I have prepared 2 returns, but I'm only filing one of them. Good. Any additional questions about that practice problem? Where do I input no income for Catherine? It is in other personal data. So there's two ways of finding it. One is remembering that it's in other personal data. You can kind of guess. So again, as you're going through here, when you're clicking on a different section, you're going to see on the right side of the screen here, you're going to see what kinds of things are included in that. So if I'm clicking on other personal data and I'm going down, one of them down here will say no income. Or if you can't remember, just go into the keyword, which is no hyphen income. So that's a keyword we use semi-frequently in an office. It might be a good one to have in your back pocket. You may find by the end of this course that you have a list of useful keywords that you do all the time. I have my own. No income is one of them. First year is one of them. Tips is one of them. Dues is one of them. Things that come up all the time and they're easy to remember. So when I started this course, I made a list of the ones I found I kept using that were pretty easy to remember. And then the rest of the things on here, I find using my Smart Start. Okay, so clear your warnings, check your notes and diagnostics, and make sure you have your notes and your check marks. Catherine will have 0 check marks because Catherine had 0 tax slips. Okay, I'm going to keep going. But if you need me to go back, it's always a good time to ask a question. And let's take a look at Robert Ward next. So we have Robert Ward, who is living common law, and we have Kim, who doesn't want to file a return, doesn't have any benefit of filing a return. In this case, how many tax returns did you create? How many tax files did you make? So Karina says 1. Helene says 1. I agree. Essentially, the only thing that is going to be shared between the two of them is a spousal amount. There is nothing else complicated and dependent related you have to worry about. So let's not do extra work if we don't need extra work. As soon as children are involved, we're going to be doing 2 returns. Why is that the case? So once they have a child, if that's what they're planning on doing, because for CCB they both have to file. So at that point, when we have children involved in married couples, we are always going to be doing 2 for now until they change the rules. But in this case, no children, no dependents, no extra benefits we have to worry about, no complicated dependents or transfers we have to worry about. So we're just going to do 1. All right, so we're going to do 1. We're going to double check that. I want you to make sure that you made it a common law spouse and not a married spouse. You should not tell the CRA people are married if they're not married. It changes what happens if they separate and then they get back together. So we have to make sure our records are accurate. Did want you to double check that he picked elections, Canadian citizen, yes, but no to the elections question. So make sure you're still watching out for that. We're going to have some income on line 11900. We're going to have a deduction that I wanted you to check. I want to make sure you have a spousal amount. Let's take a look at all of that. So going into the problem, nice, easy, straightforward problem. If I can get it to load, we're just going to have a day where the computers don't work. I'm going to let that think for a minute. Let's try it this way. Right. It can keep thinking, and we're going to go in here because I have the file here. So going into Robert Ward, on the first page, make sure you have living common law. Make sure you have the address in. Kim's information will be in there with 0 for net income. You can only get that if you've cleared your warnings. You should always, always clear your warnings. And we have a yes and a no. Double check that. We had some EI income. The EI income is there. Normally when we see EI income, we start worrying that they're going to be amounts owing, but it wasn't a huge amount of income, and there is a huge spousal credit. So in the back of my mind, I'm going, that income's going to affect things a little bit, but I'm not going to be overly worried yet about a balance owing. Then I'm going to take a look at an RPP deduction, make sure the union dues are in. They are. And when we get down here, we're going to be having our spouse or common law partner amount, which should take care of the EI problem. And we have some donations. I'm going to put the donations in. And then at the very bottom, big refund. So my next question for you, what's the reason for the refund? So I want a list of everything that created an unexpected refund. Not everything that created a refund, but everything that created an unexpected refund. Okay, donations, definitely part of the refund. Dependent spouse, absolutely. Union dues, RPP, very good. So what I would expect your answers to be, RPP, union dues, spousal amount, I put common law just for myself, donations, 4 things, 4 notes. Those are the things we will give you marks for saying. Excellent. And then just a reminder here, we had to do spouse not processed. In this case, it is the most efficient way. We're not going to create a file for someone we don't need to create a file for. So we have Kim, and we have a SIN number, birth date, income is 0. But pension adjustment is not going to create a refund, but it is going to change RRSP limits. So remember, anything on the very left side of the tax return does not affect the actual refund or balance owing. It's a reporting figure. So RPP, yes, but pension adjustment, no. Okay, and then I made my own extra note, which was optional but not necessary, which is in this year, and I'm still going to make this a notes annual because it's relevant to this year, possible moving expenses not claimed because employer paid for all moving costs. So that was my note, so that when the client comes back 2 years later and said, oh, I heard we can claim moving expenses. Why didn't you tell me that? I would have claimed moving expenses. I'm not going to remember 2 years from now that they had their employer pay for everything. Rather than having a half-hour or 45-minute interview with the client to sit down and look into all of this and kind of bring them into the office, I just have to open the file really quickly and go, oh, 2021, let's see what we have. Look at my notes. Oh, yes, you did move that year. There's a reason we didn't claim them, and this is what it is. Things I want to remember go into my notes. If you ever open any of my files in a real office, you will find that they have notes, unless the notes are so complicated I have to save them in a different format because I have some complicated files. But definitely, if I'm doing a return that I would consider a level 1 return or a fundamentals level return, you will find that I have very good notes in there. All right, and I had another question for you on this one, which is, what advice might you give Robert about his charitable donations? Okay, so I'm going to take a look at the charitable donations. And if we look here, we have donations of $125. Nice big refund this year. What might you recommend? Marisa, you might save it till next year. Good. Because he's getting about $18 out of it. Not a whole lot. In a refund that big, would he notice whether it had $18 more or $18 less? Probably not. At that point, it's just a really good refund. If he saves it till next year and he has the same amount next year, and we're already going to be getting more, and he might need it more next year, depending on what happens. So it might be a better option to save it. He won't notice the difference. If you give him the difference between the two amounts, he'll be like, yeah, they both sound good. So that would be something I would always look at. Let's look at another question that I had there. If Robert and Kim were renting an apartment in Manitoba, what provincial credit would you recommend that they consider claiming? So Karina, you're thinking in the right, but not rent assistance. We're going to call it the rent credit. Rent assistance you apply for if you're low income, but the rent credit or the education property tax credit, to be correct, probably applies to them if they're renting here. So I haven't taught you the data entry for that. I will in our last class teach you the data entry for provincial specific things, but I want to show you the difference on the return had they had one. So the return as you were expected to do it was $6,194. If I add a rent credit, and I think I did this in advance, I did, they would have gotten another $525, and that's going to bump them up again to $6,719.25. So if they have rent receipts, we would be able to go ahead and calculate that rent credit for them. It's going to generate an MB479. It's going to look exactly the way you think it's going to look. Their personal tax credit is zero because his income is too high, but we would be filling out the second page, which is going to have their address, the number of months that they were resident, their rent. So this, if I have rent for 9 months and it was $1,000 a month, and they're going to get $525. And yes, Karina, it's only $525 because it used to be $700, but then they reduced the rent credit and they're reducing it again. Next year it will be less than $500. I think it'll be $480 something. But it's going to keep going down until it theoretically goes away. Now, I will say, and I will update this in a couple of weeks, we've just gotten a tax update for some changes that are coming down the pipeline for that education credit for renters. So give me about a week to do some extra research to see if I can solidify some details, and I may have an update for the education property tax credit specifically for renters, because they've just announced a tax change for next year. All right, so that's that one. I did want to show you one more thing for Richard and Catherine that you might have considered, which is she has an infirmity and they live in Manitoba. What additional provincial credit can you think might apply depending on what type of care and assistance she needs? So we're going deep into our provincial knowledge here. And I will see if I can give you I can't give you a hint. I need to open a different form for a hint. But if you have someone who requires care because of an infirmity or a disability, and they live in Manitoba, and someone is providing that care for them, what credit that is only a Manitoba credit can you think of that might apply in this case? There's your hint. Primary caregiver. It's not guaranteed, depends on, we don't have enough information, but if she was in an accident and is requiring a lot of care and assistance, maybe she needs help dressing, maybe she needs help maneuvering from a bed to a wheelchair, or getting in and out of vehicles, or getting to appointments, all of those types of things. Helene, it can be for spouses. And that one I had to look up too, because it's not necessarily obvious, but it is for anyone that you are caring for. So if you're not sure if it qualifies or doesn't qualify, go look it up. But in this case, he could apply for primary caregiver. And again, I wouldn't necessarily expect you to know for sure one way or the other, because those Manitoba credits, a lot of things do not apply to spouses, but some things do. So if you're not sure, think about it, have it in the back of your head, and look for it. What I would like you to do in this class, and I know this is asking a lot, but if you get your problems done and you have some free time, go back to look for the return itself as a whole return and go, what else could I be missing? especially drilling into those provincial credits, because in Manitoba they make a big difference. And Helene, should you have claimed it? Not necessarily for this case, partly because I haven't taught you how to do it yet, but you should have thought about it. And that's what I want to get everyone doing. When you look at these cases here, we're going to give you federal cases, we're going to test federal things. I want you to keep thinking, is there a Manitoba thing I should think about? If I haven't taught you how to do it, that's fine. Ask me questions. I would like you to challenge me. Oh, did you think about this credit or this possibility? Because if you're doing that on a regular basis, you're going to do it in real life as well. We give you everything to make a federal return easy. I want you to think provincially as well. Good. So that's extra. That's beyond what we expect. Not going to be tested on any provincial credits related to tax returns for your TPS exam, but I would like you to get comfortable with them because you do better returns if you have them. So just to give you an example, we have the Tenenbaums. If we do a regular refund for them, $4,753, they're happy. If you dig into the family a little bit, you ask what type of care they're giving, you would inform them of the primary caregiver credit. They investigate it. They think it might apply to them. They apply for it. Had you done that, if it was appropriate, look what happens to the refund. So this is where knowing your province-specific things in Manitoba especially can take you from being an excellent tax preparer to a phenomenal tax preparer, which is what we're always aiming for. Excellent. Any more questions? I think that's going to cover everything that I wanted to do for this section. Okay. And so what we're going to go into next, I'm going to flip over and we're going to start looking at our next chapter. Just a quick reminder here, we are going to be using a couple of files. So make sure you have your Dave Duncan file. We're going to open that one first. We're going to do the Betty Robinson file as an example, and then Lillian Richards. So I hope everyone got the email that I sent out suggesting that you get your Lillian Richards file started. That's going to save us time on our data entry. As I send you the slides at the end of today, you're going to notice they're not in order, and it's not in the order of the book. That's because I want to make it so that we can efficiently get through class and we're not flipping back and forth between files. So I'm going to do a couple of things first. I'm going to do workers' compensation benefits and social assistance first. Then I'm going to do the home buyer amount, and then we're going to jump into the rest of the investment chapter. So we're going to do the first two things, probably take a break, and then jump into our Lillian Richards investment file. Okay, so I'm going to share my screen again. And I'm going to start by opening up my Dave Duncan file, which hopefully I have here. Okay. And just a quick reminder for Dave, what kinds of income he had. He had some employment income, he had some EI benefits, and that was it. I'm going to let you know now, we're going to add a little information here. Oh, I've got to pull up my windows. Adding a little bit of information to our Dave Duncan file. I'm going to tell you he forgot to mention that he also had an accident at the beginning of November, and he received some workers' compensation for 2 weeks. So he's going to come back in to update his file, and he's going to tell you that he has a T5007 with a box 10, which has, I will give you a number, $678.50 in the box. So we're going to enter that the same way that we enter anything that isn't a T4, which is in the T-slip section. So under the T-slip section, I want you to now find a T5007. You're going to have to scroll down for this one because it's not one of our more common ones. I will say that depends which office you work in. But if we go down far enough, we're going to find a T5007. Select that. Usually the name will be some government body, but it's not mandatory to fill it in if you don't have it. Generally, you probably are going to have a payer province. And then you have 3 boxes. And I want to remind you, we're in Manitoba, we have 3 boxes. There's a box 10, a box 11, and a box 14. Okay. Workers' comp is box 10, so we can put the workers' comp in. Nice and easy. That's all we have. However, if you have social assistance, You will also have to include whether or not there is a spouse. Why is it important to know if there's a spouse when you enter a social assistance slip? What is the rule for social assistance received by spouses? So if we have two spouses and one person has received social assistance, whose tax return is the social assistance reported on? The higher income or the lower income spouse? All of these little details that are impossible to remember, but you have to think about them, it's the higher income spouse. Social assistance has to be reported by the higher income spouse. So you have to tell the computer that there is a spouse. Now, if you have the spouses connected, it's not a problem. And Helene, even though they didn't get it, yes, because the family got it and social assistance is considered to be there for the family. So if you have connected files, that box won't be particularly important, but if you're doing related party spouse not processed, it is. And then if we had social assistance, if this had been not workers' comp, but social assistance, you would be putting a box 11. You're never going to have a box 10 and a box 11 on the same slip. You'll have a different slip for each one. But if you had social assistance, it would be a box 11. And in Manitoba, you must enter something in box 14. You must. It's going to be a 1 or a 0 or a number between 1 and 0. The problem we're going to have for this course is that it's a federal course, and Manitoba is the only province that has this. So in this course, when you see a T5007, it won't have a box 14, so I'm going to give you one. So you're going to notice when we get to our practice problems for this week that you're going to see in the answers that I have added a box 14 where it is appropriate for there to be a box 14. It's really easy to miss that. When we do our autofill and we're copying things over, we're not always careful and we miss that box. If we're doing manual data entry and we miss that box, it's often a really bad result for our client because we might be calculating provincial credits that they're not entitled to based on the number that goes in that box. So I cannot stress enough how important it is. In Manitoba, T5007, look for a box 14 if it's social assistance. Make sure you have entered it. All right, so we're going to do workers' comp. In this case, it's workers' comp. It is a tax slip. We're going to double check our data entry. Did I give you the right number? It is 678.5. I did. Put a check mark on the first number box, which is box 10. Then we go to the tax return and see what it did. Remember, workers' comp goes on to total income and comes off taxable income. Let's see if the computer did that correctly. So I'm going to go down here. You're going to see workers' comp is going to show up in line 14400. It's added to total income. It's going to change Canada Workers Benefit. It's going to change anything that is calculated for net income. And the computer will automatically take it off on line 25000 as well. So it will do the right thing if you give it the right information. The tricky bits, remembering the box 14, and if it's a spousal situation, you want to make sure that it's being reported the way it's supposed to be. So I will say if you have spouses and you have social assistance, you should be checking to make sure that the computer is reporting on a higher income spouse. And if they're not, double check your data entry and see if you missed something. Okay. What will this do to his final result? So if he came back in after you'd filed the return and he said, oops, I missed a T5007, do we have to do an adjustment? Is that going to change his refund or his balance owing? No. Good. So we can correct it. It's a very easy adjustment to do. Put the income on, take the income out. It's not a bad thing to correct your tax return, but he's not going to have a penalty or a debt for not reporting that slip. It might cause a problem if it had been social assistance that he hadn't reported, because that might have changed provincial credits. But if it's workers' comp, you can do the adjustment very easily, but it's not going to change. So you can tell him, don't worry, you won't owe money after we do this adjustment. We're just going to correct the record for the CRA. I would be doing that adjustment online. It'd be done in about 3 seconds. He would have a result pretty much right away. And then he can confidently go on and worry about which slip he's going to forget next year. All right. So that's how we do workers' compensation and how we do social assistance. Okay. If you pick the wrong slip, you won't get the right data entry. And other than that, it's pretty straightforward. Now what I'd like you to do is close Dave, and we're going to go into Betty. So can you find your Betty Robinson file? I'm going to remind you who Betty Robinson was. Betty Robinson was our nurse who had some College of Nurses professional fees and a GST rebate. Okay. I'm going to give you some information about Betty that you didn't have before. I'm going to tell you, assume that Betty Robinson moved this year from a rented home into her first home that she's purchased. She has not owned a home in the last 5 years. Now she's a homeowner. She didn't change jobs. What should I be thinking about adding to her tax return? First-time homebuyer. Okay. The thing I want you to remember about first-time homebuyer is if you put it in, you are telling the computer that they are eligible for it. You could put all kinds of other things in the computer that are going to scream at you they're not eligible for it. But it will give it to them if you tell them to. So make sure if you're putting in first-time homebuyer amount that you mean to put it in. How do we put it in? Well, it is a credit, so you're going to look for the credit section. So it's going to be below the income and below the deductions, and you're going to find home buyer's amount. If you click on that, you're going to find the keyword is home-buyers-AMT. That one I don't have memorized because I don't do it often enough. It does happen, but I don't do it all the time, so I like to use a Smart Start for this one. You're going to find home buyer's amount, and very simply, you're just going to say home buyer's amount, and then go to the tax return and see what it did. So if I do that, and I go to my tax return, there it is. Don't have to do anything else. In this case, it was easy because she bought the home herself. However, what if she bought the home with her best friend and they are sharing the home 50-50 and they're both first-time home buyers? What can we do in that circumstance? If they want to split it, they can. So I want to show you how to split a home buyer's amount. So if you're doing just one home buyer's amount, pick the person you want to give it to, put it on their data entry, they get the home buyer amount. Nice and easy. If you want to split it, you have these other boxes here, which is claim. How much do I want to claim? The default is the default. Never choose the default. Just leave it blank. It will already happen. But if I want to claim part of it, I can say just claim part of it. So how do I claim part of it? I'm going to share the claim. I can share it with a spouse if I want to split it between spouses, or I can share it with someone who isn't connected to this return. To share it with a spouse, you're going to say how much they have to have a spouse. Maybe I want $2,500 for her, and then the spouse will claim $2,500. She'll get the rest. If I want to share it with another person, I'm going to say amount claimed by this person. How much does she want? $2,500. That's what I would do. Leave it at that. And then on the other person's return, if we're doing their return, they will have the same data entry. Okay, so nice and easy. You can decide how much it's going to be. You don't have to split it 50-50. You can split it any way you want to split it. If I limit it there, it's going to limit it on her tax return. Okay, but again, I cannot stress enough, if you put home buyer amount in, the computer will give it to them. So before you do that, you want to make sure that A, they are entitled to it, and B, you can justify the claim. What are some of the clues you might have that someone might qualify for this? What are the things that will trigger that question in a client interview? Address change is a big one. Good. What about a T4 RSP? In what circumstance would a T4 RSP be a trigger that I might have a first-time home buyer amount? if they withdrew under the home buyer plan. The only way to do that is to be a first-time home buyer. So if you're a first-time home buyer under the home buyer plan, you're probably a first-time home buyer for the home buyer amount too. So that's a good trigger that you have a question. So the two big things we're going to see is if they've moved, oh, congratulations, where did you move to? Oh, I bought a house. It's really exciting. I've never owned a home before. Great. Now we're having a conversation and I'm giving them $5,000 credit on their tax return. Or if they're not talkative and I've asked them that question, they haven't volunteered anything, and maybe they're a new client, so they've just given me one address and I didn't know they moved and they didn't mention it even though I asked. The next thing that might happen is I might see a T4 RSP slip with a home buyer plan and I'll go, oh, you withdrew money to the home buyer plan. Did you buy your first home this year? Yes, you did. Great. Here's what I'm going to do. Good. So I'm going to take this out, the split. I'm going to leave the actual home buyer amount in, and I'm going to take all the extra things out and just leave the default. I'd like you to do the same. So we're going to have that one sitting on Betty's file. What's going to happen to her return when I do the home buyer amount? What's the net result going to be? It's going to increase, which is great. And then I'm going to add another note to my file. So if I've done that, I can go into my data entry now. I can go find my note because I've added something to it. Open up my note again. Oh, I didn't do this one, so I don't have notes. So let me do notes for Betty. Do them very quickly. Going to do RPP union dues, GST rebate, home buyer plan. Do notes annual, refund over 500, RPP, union dues, home buyer plan, GST rebate. There we go. Nice and quick to do notes. Good. Any question about the home buyer plan? Again, if you put it in and it's obvious they shouldn't get it, the computer will not know that, even though it probably could do that. So if you have put in a sale of a property somewhere, if you've done a principal residence information so the computer knows they sold a home, you can still put in home buyer plan. I mean, you shouldn't because they won't get it when the CRA looks at it, but the computer will let you do it. So this is one you really have to think about. Okay, that's where I want to stop for now. We're going to take a break. I'm going to take a break right until 10 o'clock. If you haven't done your in-class exercise for Lily Richards, just the personal information and the T4, I want you to do that now because we're going to jump in and we're going to do the data entry for that file next. So take a break until 10, and when we come back, we're going to jump into investment income. So welcome back from break. I want a quick check mark, make sure everyone is here. Good, I've got a couple of people also making sure the audio is working. We're just not having a good computer day, so I want to make sure you can all hear me as well. Great. So just in case there was a really good question right in the middle of the break, which I'm going to repeat again, which was from Helene, the home buyer's amount is also used for people who get homes with better disability access. It doesn't have to be their first home. That's right. It is important to remember for home buyer plan or first-time home buyer amount that it can apply even if you have owned a home in the last 5 years in that one exception. So you will have to identify that, and when you do, you're going to be doing the same data entry. But I would also put a note in the file if that's what's happened, because you've done the data entry, you've given them a home buyer amount, and then you're going to say, move to a more eligible home for this person, and that's why they qualify for it. Excellent. Good. So we're going to jump in now to our Lillian Richards file. We have a client now who has a particularly interesting set of investments. And again, don't work faster than me. I'm going to be adding things. I'm going to be demonstrating things. I'm going to be taking things away. So it's going to change really, really quickly as we go through this. But I do hope you all have done the first step, which is getting her personal information in. We have Lillian Richards. She is widowed. We have a phone number. We have a mailing address. And you should also have let me see if I can get my T4 with your quality at source check mark on it if you have double checked your work. If we have this, and this is the point we're at, what I would like to know is what is the refund or balance owing for Lillian Richards right now? So if this was the only thing she had, what is the net result? I'm going to open this up so I can see it. Wait for someone else to do it first. 809.30. Excellent. Okay. Just a quick reminder, if you haven't got information, don't put information in. So this is something that I do say every year, and then at least one person will do it. If you don't have an email for a client, you don't want to put in something that isn't an email. You're going to get a big warning. It's going to ding in your ear a whole bunch of times. So if there's no information, just leave it blank. Some people don't have email. If they don't have email, they don't have email. If they don't want to give us their email, they don't have to give us their email. It means the only way we have reaching her is by phone. In this case, I might ask her if she has a second backup phone number. If we can't reach her at the first number, is there a second place we can reach her? And worst case scenario, if you can't reach your client any other way, you can mail them. So we've definitely had to do that for some clients where they change their phone number every couple of weeks and they don't really have an email, and we have to get in touch with them. If we have a mailing address, that's another way of getting in touch with them. All right, so we're going to talk about some investment income now. I'm going to do these a few slips at a time and see what happens. So we're going to start with the first one that I have here, which is a T3 slip. So a T3 slip, she has invested in a company called Horizon Investments. We're going to have some different boxes on that slip. Now, in real life, those boxes will be identified. So when you look at the slip, you're going to know what each of those boxes is. But you're going to find in the data entry, it will also identify it there. As always, every slip that isn't a T4 is going to be found in your T-slip section. So when we go to T-slip, you're going to find T3. I want you to notice, however, there are two different T3 slips. There's T3 and there's T3 US. I'm going to come back to T3 US in a minute, but let's start with just the straight regular T3 slip. Okay. T3 slip will have lots of boxes that you don't need, so you should only enter the minimum amount of data necessary to get an accurate return. But please do put a name on these ones. If you deal with clients like me where you have lots and lots and lots of investments, I will have some clients who will have as many as 200 tax slips that have to get into the computer. And I have to know which tax slip is for which company, from which financial statement. So I really need to be able to identify what they are. Names are very helpful. Okay, so I have clients with so many tax slips that I literally can't do an autofill my return download because the computer won't download that many fields. I get to print them all from the CRA one at a time and then enter them all by hand. It's really fun. So you won't see a lot of files like that until you get into clients that are a little bit more like my clients, but it is possible. So T3 Horizon Investments. The next box we have is exchange rate. So on the exchange rate, if you have a tax slip that is in a different currency, you can change the currency for the slip because everything has to be reported in Canadian dollars on a return. So whenever you have a T3 or a T5 slip, you should do a little check around the outsides of the slip to look for a foreign currency box. If it's blank, it's in Canadian dollars. If it's got a different country in there, you're going to have to do an exchange. So rather than manually calculating the exchange rate, you can let the computer do it for you. The most common one is the US, so it will be at the top. And if you know which month you're doing a specific exchange rate for, you can pick one. For a T3 slip, it's going to be aggregate information over the whole year, so you would pick the annual rate in that case. And then if you have a different one, it might be Australia, it might be the Czech Republic, it might be reported in euros. You can find most of them here. If you can't find it here, you're going to have to calculate manually. So then you would do other, put the name of the country and type in the exchange rate. But what I will do is show you if it's United States. Now here's the crazy thing that I don't know why they do it this way, but when you pick the exchange rate, It doesn't automatically do it for you. You actually have to type which rate you want. So you're going to say United States, you're going to read the number, and you're going to put 2535. So that's what happens, and that will then convert every number you put in a box on this slip from an American number to a Canadian number without you having to do the math. Okay, so if you had an exchange rate for this slip, you would do that. We don't, so I'm going to delete it, but I wanted to show you that it is there. All right, and then we're going to have to find out what all these boxes are. So what I like to do is look for the box one at a time and then find out what it is. You're going to notice they're not in numerical order. So we're looking for a box 21. As I go down the list, I'm going to find a box 21. I'm going to look over the side. I'm going to go, oh, that's capital gains. Capital gains has a drop-down box. The only one you're going to use is capital gains. So we're not going to deal with split income, foreign capital gain portions. If you have a client who has those scenarios, you need a specialist. For you, regular T3, and believe me, you will see these. These are very common. Just pick capital gains, and we're going to put 378. As soon as I do that, the computer will calculate a schedule, will generate a Schedule 3 for me, and will calculate the taxable portion. So I don't have to do any of that. I just have to get the box in. All right, so that's the box 21. The next one that I'm going to look at, I'm going to go over to the right here. We're going to do boxes 49, 50, and 51. Again, if you don't remember what those boxes are, you're going to find them somewhere in your list. I will tell you there at the top, and then you're going to read what they are. And what we have is an eligible dividend, actual amount, taxable amount, and dividend tax credit. Now here, and I cannot stress this enough, please remember this, only enter the data you need. If I put a box 49 in, the computer will know what the box 50 and 51 are because it is a calculatable number, and computers are good at calculating things. So if I put just box 49 in and I go to the tax return now, what I should expect to see on the tax return is this amount on my federal worksheet and this amount for my dividend tax credit. I haven't entered those numbers. I haven't put a zero. I haven't done anything. I've just left them where they are. But if I go to my investment worksheet now, you're going to notice that it put the correct amount for my taxable amount. And if I go to my dividend tax credit, it also put the correct amount there. Because the computer can do it, you shouldn't. Again, one of the most common errors that we get in tax returns is people typing these in really quickly, and they might do something like this. And all of a sudden, I have now underreported their income because I read it wrong. So don't put in data if you don't need to put in data. You will be marked on this. We are going to be testing if you are using best practices. If you see dividends, pick one box, put one box in, and that's it. Okay. Again, it seems like a little thing. Why does it matter? It matters because when you do 300 returns in a year, you're going to make a typo. Helene, always the first one. I find it easiest to do the first one. So the first box number I come to is 49. I do 49. You could do any of them, and the computer would calculate it correctly. So it doesn't matter which one you do, but don't do more than you need. And again, it's just easy. You get there, you see 49, you go, I've done 49, cross out the other two boxes, you don't need them. And Brittany, if I'm you, I make a typo on every return so the computer can do it, no complaints. Yes, and this is reality. We make mistakes. I have definitely made mistakes on tax returns. I want to limit the opportunities to make those mistakes, so this is one really nice way of doing it. It also means when I'm double checking my numbers, I have one less number that I have to look at. And if I have to find an error, I have one less one that I have to look at. Remember, my client with the 200 tax slips, if I have to go back and double check those 200 tax slips, I would rather only have one number to look at and not three numbers to look at when I'm reviewing the tax slips and going, where did I make a mistake? So box 49, just enter and then leave the other two boxes blank. Okay, Going on to the next one, box 25 and 26, we have to find those boxes, and I'm going to tell you they get a little trickier when we get out of the easy boxes. So the easy boxes are going to be box 26, which is other income. On the tax return, it's going to say other income. When you drop it down, it's going to say other income, and that's all you need to worry about. When you get into these other boxes, 24, 25, 26, it can get a little bit trickier to know what you're doing. So you're going to find some of them will say a number and a plus. So I can tell you that box 25 is foreign income, and you're going to have to choose between dividends and interest. Your clients won't have foreign income business. It'll be dividends or interest. Generally speaking, it's going to be interest. So usually box 24 would be dividends, box 25 would be interest, but it doesn't specify. So I will tell you for the purposes of this course, we're going to be entering foreign income interest. Box 25 will be 3615. And what you're going to notice is as soon as I did that, I got a warning. Okay, so I got a warning. The warning is going to tell me, so every time you get a warning, read it. It's going to say, if you have foreign income, you must also enter foreign tax. You do not have a choice. You must have an entry for foreign tax. Okay, so anytime I put a box 25, I have to have foreign tax. If I don't have foreign tax, if there is no foreign tax listed on the slip, then my foreign tax is going to be 0. So I've done foreign income. I'm going to go find my foreign tax. I have to make it match. If I picked interest before, I'm going to pick interest again, and then I'm going to put 0. And I can tell you if you have questions about why I picked interest and not dividends, generally speaking, if it's interest, there will be no foreign tax withheld or foreign tax paid. And that is the most common thing you see. So if you do see foreign tax on a tax slip, you should go reach out to a specialist. That's beyond the scope of this course. So for this course, it's going to be interest, and it'll be foreign income tax, interest tax. Well, you have to enter 0. Good. Any questions about that one? Box 25 for this course will be foreign income interest, and then you have to put the tax, and the tax will 0, and you have to enter it or you're going to have a warning. All right, then we have box 26, which is other income. Other income goes on our other income line. Choose other income for the option, put 145. And we are done the tax slip except for IMA fees. So at this point, I'm going to do my double entry. I'm going to double check my numbers. I've done box 49. It is correct. I'm not entering 50 or 51. I've entered box 21, and I specified capital gains. I've entered box 25. I got the right number, and I put the foreign income tax as 0. I've entered box 26. I said other income. Everything is correct. Put a check mark there. I have to go find the IMA fees. So what can I do with IMA fees from a tax return perspective? It is a deduction. Here's the fun part. It's not on the slip. You're not going to find a footnote section on the slip. Okay, so what I have to do now is I have to find the appropriate place for deductions. So I'm going to go into my Smart Start, and I'm going to go down to my deduction section, and somewhere down there you're going to find carrying charges. So carrying charges is a separate piece of data entry. Carrying charges, we have 3 options. Doing this a little bit out of order because I want to make sure it flows with the tax return. So our options are interest carrying charge or other investment expense. And then we have that legal fees alimony. So if you have legal fees related that go on that line number, it's the same part of the worksheet. There's where you're going to do your data entry for that. In this case, a carrying charge is going to be under other investment expense, and I have to pick. Is it a management and accounting fee or a fee paid to an investment counselor? IMA, by definition, management and accounting fees. That's what the MA stands for. So I'm going to say management and accounting fees, and I'm going to say $285.50, and I'm done. I want to show you where all of that ends up on the return. So we've done dividends. I want to make sure the dividends showed up. We've done other income. I want the other income to be on the other income line. I've added foreign income. I want that on my foreign income line. I've added capital gains. I want that in a Schedule 3. And I've added carrying charges. all of those numbers should be on my tax return somewhere. Let's go find it. So I now have dividends, interest, taxable capital gains, and other income. And if I click on other income, it's going to take me to my worksheet and tell me where that came from. And if I go to my investment page on my worksheet, you're going to see this dividend came from a T3 slip. That is correct. You're going to see I had a box 25 on my T3 slip. That is correct. It went into the correct line. And you're going to see my dividends, again, income from foreign sources, and my carrying charges on my carrying charges section. And I have a Schedule 3. On my Schedule 3, I'm going to make sure that it is correctly related as my T3 income on line 17600. If you do your data entry correctly, the computer will put it in the right place for you. Okay. Any questions about the T3 slip up till here? I do have one more thing that I have to show you, which is not going to be relevant to Lillian, but might be relevant to some of your clients. If we get to the bottom of the slip, I want you to notice that there's a box called Own Share. Remember that you may have an attribution rule scenario that you have to deal with. So it's possible that this investment is held in Lillian's name, but was gifted to her by her spouse, who is still her spouse. In this case, she doesn't have a spouse. It's not going to be relevant. But if you have an attribution rule and you have to do that, you're going to download the slip, you're going to copy it over, and then you're going to go in and you're going to say how much of this is actually hers. So maybe she only had 50%. If the rest of it had to be attributed to someone else, then we're going to say, what do we do with it? And we have two choices. We can transfer it to the spouse. If they're connected files, it will do that for you if you choose that. Or if they're not connected files, because you're only doing the file for one person, you're going to say ignore remainder, and then they are going to add that on. Okay? For this course, you are not going to do split income. That will not be relevant for this course. Okay? But spouse share, own share, versus splitting with someone else, if there's an attribution rule reason to do it, or if it's a joint account and we have to put it by proportion of who put the money in the account, that's where we use this own share. And what you'd notice, as soon as I say 50%, when I go to the tax return, it's going to drop everything down and only 50% will be reported on hers. Okay. Any questions about that? If you've done that, I'm going to ask you to take it out because she doesn't have a spouse to attribute things to, or to split things with, or to have a joint account with in this case. But it is important to know that that box is there. I use that box all the time. Okay, now remember how I said you can change the currency? If you're changing currency to anything other than US, you have to use that exchange rate line. However, if the entire slip is in American dollars, instead of entering the slip here, what I would do is I would enter the slip here, and I don't, in that case, have to enter an exchange rate. So let's just assume that I had a T3 slip, and I'm just going to call this one test because I'm going to take it out in a minute. But if I had a T3 slip and it had, what's a really good one for me to put in here? I had some foreign income interest, and let's say I had $500 of foreign income interest. It's going to give me a warning. It wants my foreign tax. I'm going to put my foreign tax in at 0. And if that's the only thing on my slip, you're going to notice I haven't put an exchange rate in. Theoretically, what the computer should do now is it should increase my foreign income information, income from foreign sources, and if I take a look at what ended up on there, it has done the exchange rate for me. I didn't do it. I put 500 in. It made it $626.75 without me doing anything else. So the time that you will use the T3 US is if you want to do a T3 US quickly, because you don't have to do anything else. Okay. They do happen. The trick is to notice that foreign currency box. All right, I'm going to take that out because she didn't have that income, but I wanted to show it to you. All right, we have done T3s. Unless you have more questions about T3s, hopefully that is going to show you the income. I cannot stress enough, if you put boxes on, make sure they make sense. Because if you put the data in the wrong box, it's going to go on a different line. And that's not going to help you because you're going to be underreporting or overreporting. Remember, these slips will be matched by the CRA. The CRA has these numbers. So because the CRA has these numbers, if they don't match up, they're going to add income, but they won't take income away. You might have a client who will get multiple T3s for Horizon investments. So she might get one slip that has some dividends, and then another slip that has a bit more dividends and some other income, and then one slip that has the foreign income and the capital gains, and they're all the same company. If that happens, you can put them together on one. As long as the totals match what the CRA has for their totals, that's fine. We do that to keep the cost down for our clients, but when you're doing that, you have to be extra careful. So for the purposes of this course, I'm going to ask you not to amalgamate any slips. We're not going to give you any you have to amalgamate. It's just if you get into an office and you do the download and you get 5 different T3 slips, and then the client brings you one summary slip, you don't have to enter the 5 slips. If all the totals add up to the one slip, just put one slip in. Okay. Good. So there we go. Let's take a look at the next type of data entry that she might have. And this one I have to give you. So what I want to talk about now is a different type of slip called, oh, question. Yep. I will wait for the question. When I do autofill, will 50 and 51 be entered? It will, in which case I will not delete them intentionally. I will leave it because I didn't type it, so I can't have made a typo. So if it's autofill my return and it's there, I leave it alone. If I'm typing it in, I'm going to type in the minimum. So excellent question. The tricky bit there is just to make sure you do copy everything over correctly. But it's easy to tell if you did because the 2 lines will match up. So you'll see autofill much more if you're working in an office when you do your on-the-job training. It's not something we can easily demonstrate in the classroom setting. And to be fair, at the beginning, when you start doing tax returns in February, we're not doing a large amount of autofill my return because not very many slips have been uploaded yet. So the first couple weeks we're doing tax returns, we're still doing all that manual entry anyway. So it's really good to practice it. All right. So what I'm going to do now is I'm going to show you what would happen if she had a T4PS, which is a profit sharing plan. So if she has a profit sharing plan, we're going to find a slip called a T4PS, which is going to be kind of in the middle here. Again, if you pick the wrong slip, you're going to have the wrong entries, the wrong information. So if she had a profit sharing plan with work, that's the district school board. Again, if it's in foreign income, you can do an exchange rate. I'm not going to in this case because it's a local school board. I want you to notice there's a lot of things on here that are going to look familiar. It's the same type of information you see on a T3 or a T5. You might have eligible dividends. If you have eligible dividends, you get 3 boxes, just enter one of them. If you have other than eligible dividends, you could have 3 boxes there, just enter one of them. So if you have box 30, 31, 32, pick one. You have box 24, 25, 26, pick one. You might have some other income. If you have other income, you're going to enter that in here, and it will be profit sharing plan income. You might have some foreign income. If you have foreign income, capital gains, or other, you will have to enter foreign tax. That's handled the same way. And generally speaking, these slips will be straightforward for you. It gets trickier if you have a specified employee. So we don't teach specified employees and how to handle them in this class. I am going to show you the data entry once because it's going to be in your book, and I want you to know how that works. Okay, so I'm going to give you some information here. And let's see, I want you to assume that Lillian has several boxes on here. I'm going to give you the names of the boxes. So she's going to have box 35. I'm going to put T4PS here. Box 35 equals 4,800. Okay, box 41 equals the same, and box 40 has a check mark. Okay. So in this one, the question becomes, what do we do with it? Box 35 is other income, that's profit sharing plan income. If I just enter profit sharing plan income on its own, I need to find out where that would go on the tax return. So I'm going to go to her tax return. I'm going to look for her income page, and I want you to notice profit sharing plan income is considered other employment income. It goes on line 10400. Okay, so if it's a straightforward client, not a specified employee, not too difficult. But when we get into specified employees, we run into some problems. So now what I need to do is find my box 41, and you're going to notice it's not there. And the reason it's not there is because it only applies when I have a specified employee. So if I choose specified employee, it's going to make a new section open up. And that new section is going to say, put in your box 41, which I will do. And now it's going to say box 35 again. And even though I've entered it before, I have to enter it a second time. So I have to enter it twice. Okay, I'm going to show you that one more time just so you can see me do it. If I've entered my T4PS, I've put my box 35 in. I find that I have to put in a box 41. I now know I have a specified employee. I check box 40. It has a check mark. I'm going to say yes. I need to put in the amount of contributions from the same employer, which is $4,800, and I have to enter the box 35 again. Even though I've done it once, I have to do it a second time. Okay. When I do that, I'm going to go to the tax return, and it's going to create some additional forms. Okay, so the form that it's going to create is a tax on excess employees profit sharing plan, and you have not learned how to do this form, and you haven't learned what this form means. So I'm going to show you roughly what's happened, which is we have what's called an excess ESPS amount, and what it does is it adds extra tax onto your return. So in this case, it's going to add $2,419.20 of extra tax onto Lillian's return. It adds it in kind of a weird place. It adds it on line 41800. So if we go up and we find line 41800, it's not where you're expecting it to be, but it comes in as special taxes. Okay. So now I have created a scenario where she's going to owe some money because we've added some income that wasn't taxed. We've added some income from her T3, and we've added some income on the T4PS plus a special tax. Okay. Now, what I am going to show you in this case is there's a second thing that can happen, which is she could have another box, which is her EPSP Employee Inc. So I'm not going to explain the tax theory behind this. If you ever get a T4PS with a box 40, go find a very, very experienced associate. But I just want to show you what the difference is. If she had had employment income from that employer, $15,000, you can enter that as well. So I'm going to give you the keyword for that here, EPSP. That's not what I wanted to do. Employee Inc. equals 1,500. That's going to change my return again. So now when I go to the tax return and I look at that the RC 359, I'm going to go in here and it's going to calculate a different tax on the excess amount. And now she has a special tax on a lower amount. Okay, and again, none of this is going to make sense because I haven't taught you any of the tax theory behind this. Not going to teach you the tax theory behind it. I'm going to tell you it is data entry that is in your textbook. If you ever have to do it, go find a senior associate who knows what this form is about. But you now know how to do it. I have taught you how to do it. If it comes up in a practice problem, you know how to do it. Okay. This one, I would not spend a lot of time studying. I would just remember there's a weird thing about profit sharing plans. It's in my textbook, and if you get a T4PS and you're not sure what to do with it, use it as a reference guide. So this is one of those ones you're going to put in the back of your head, and you're going to go, oh yeah, that's the thing. Okay. So now that I've done that, I'm going to leave it in. What is our balance owing now? If we've all done the same data entry, what does she owe? Okay, 1334.78. If you got a different answer, let me know so that we can figure out what happened. Okay, good. Looks like we're all on the same page. So that's going to be the hardest, weirdest one I'm going to teach you today. The rest of them, hopefully, will be fairly straightforward. So let's keep going. And what I'm going to show you next is, let's see if I can find it in the in-class exercise. We're going to do the T5008 next. Okay? So we're going to jump down a little bit in your in-class exercise. I want you to find, actually, no, we're not going to do that one next. We're going to do the T5 first. Might as well do them in order. Let's talk about some T5s. She has two of them, three of them. She has Bell Canada, or Bank of Canada, Bank of Montreal, and Bell Canada Enterprises. These ones are going to look very familiar. I want you to notice again on a T5 we have two options. There's T5 and then there is T5 US. T5 US is what you use if you have a foreign slip and all of the income is reported in US dollars and you don't want to have to type in the exchange rate. It will do the annual exchange rate without you doing anything else. But if we're doing Bank of Canada, it's not going to be reported in foreign income. So we're going to say Bank of Canada here. Again, if you're doing any exchange rate other than the annual US exchange rate, you can pick an exchange rate here if you need to. Also on a T5, you're going to have two different types of dividends with two different sets of boxes. Only enter the minimum that you need. If you're doing eligible dividends, box 24 is good. If you're doing other than eligible dividends, just put box 10. The most common thing you're going to see is interest. We're going to put 1,500 there because that's what's in her box 13. You might have other income. If you do, there's a drop-down box that makes you only pick one thing. Don't ask me why it's still a drop-down box. It should just be other income, but you have to select that box. Otherwise, it won't work. You might have foreign income, like a T3 slip. You'll have to decide if it's dividends or interest. For this course, it's pretty much always going to be interest. If there's no foreign tax, it'll be interest. If you put foreign income interest, you have to put foreign tax. It's the same as it was on the T3. Okay, and then you might have royalties. So going all the way back to our first assignment, remember Keith had royalties that were reported on a slip. You have to pick what type of royalties they are. If they're from his own work or invention, what line number will they go on? So if Lillian had royalties from her own work or invention, what line number would it go on? Line 10400. Excellent. Royalties from your own work or invention is other employment income. Royalties from an investment or anything that isn't your own work and income will go on your federal worksheet and on to line 12100. So you have to tell the computer what it is so the computer knows where to put it. There you go. You now know everything you need to know pretty much to be able to do your Keith Docs file. If you want extra practice on investment income, go back to your assignment 1 and try to do it in the computer. All right, you might have capital gains. If you have capital gains, there's a drop-down box. You have to say capital gains. Again, don't ask me why it's a drop-down box. It really needs to not be there. Make sure you select the correct thing. Put your capital gains in. And if this is a joint account and you have to prorate it based on who put the money in, you're going to use own share. Pick which portion of it belongs to Lillian. And if Lillian had 25%, and the rest was shared by a spouse who was connected to her file, you would say transfer remainder to spouse. If there is no spouse connected to the file or it's shared with someone else, you're just going to say ignore the remainder, and then the remainder will be put on someone else's return. Okay. Any questions about that? I'm going to take that out because she didn't share the account with anyone. It's all her money. Once you have done it, Marie said you have to enter in the spouse's return. If it is joined, then the computer will do it for you. If it's not joined, So for some reason, the spouse is doing their own return separately and we don't have both of them connected, then yes, they have to enter it on their own return. So I did have that scenario. I had those two clients who were in the middle of a very messy separation where they shared a business and they had lots of investments that were held by one person or the other, but actually belonged to different people. We had to sort out in the year of separation and the year after separation in that case, because there were still assets being transferred through the divorce. We had to separate out how much each person had to do, and they weren't sharing information. They definitely didn't have joint files in our computer, so we had to calculate what was going on our return and then send a letter to the other person's lawyer and say, this is what you need to put on your return. You go figure that out. If you disagree, let us know, and that way we could file the return. So I used that percentage to calculate it, and then I did a summary chart so that they knew what to go on their return. All right, so after you've done your data entry, you're going to double check your data entry. And again, I want you to practice putting your check mark on the first box number that has an amount in it, so that when you collapse it, you can see on the right side your check mark is there. Okay, let's take a look at the Bank of Montreal. So we might have a T5 from the Bank of Montreal. We're going to enter that one. Again, there isn't going to be an exchange rate for this. We're going to have interest. Interest will be 10.20. That's the only thing on that slip. I'm going to double check my number, and I'm going to go make sure that those were entered on my return. If I've done data entry, I want to look for it. If I'm looking for it, I'm looking for it on my investment page. I should now have some box 13s from my T5 slips. And if I want to see a breakdown of those numbers, I can double click on that number. And if my computer cooperates, which it's not going to do today, I will get a summary of the income. And like I said, we're not having a day where that's going to work. But I will have a T-slip summary down at the end so I can see which slips I have entered and what box numbers they were there. So I can go down and look for it later and go, where did I get that income from? I had a box 13 and a box 13 and a box 13 from T5s, and this is what it looks like. So 2 numbers and a total. Okay. Going back to my data entry again. And we have Bell Canada. So I'm going to do another T5. We're going to do Bell Canada. Again, not a US one. It could be. They could have an American subsidiary where they are investing things. And in this one, I have a box 24, 25, and 26. I'm going to enter box 24. I'm going to let the computer calculate 25 and 26 for me. And I'm going to put check mark on it. And any one of these, if I had to split them out, I could split them out. I go to the tax return now, going back to my worksheet, going back to my investments, and I want to make sure that the taxable amount has shown up, which it did. And the dividend tax credit should have shown up, which when I go far enough down, it's going to show me my dividend tax credits on my other worksheet, I believe. Where'd it go? Where's my dividend tax credit? Dividend tax credit is going to be on page 7. There it is. And I can make sure that the 2 numbers add up to each other. Okay. Any questions about T5s? If you can do T3s, you can do T5s. The data entry is very similar for them. The important thing to remember is that they look different. And you always, when you're doing T3s or T5s, have to think joint accounts. Think about that. Think about attribution rules, because the computer will only do the data entry that you give it. If you don't tell it there's an attribution situation, if you don't tell it that it's a joint account, it won't know what to do. Okay. Going to jump ahead. I want to get as much done as I can before we take a break, but I will make sure you get one more break today. We're going to talk about the next slip that she has, which is her T5008, which is Investment Investor's Edge. For this course, we are going to test you on Treasury bills, but in real life, you will see T5008s for other things as well. So I'm going to show you a little bit about each of those, but we're only going to test you on Treasury bills. So T5008 can be used for many things. If you don't remember what it can be used for, go back to the chapter on Chapter 7 because we talked about it at length there. You can rewatch that recording anytime you want to. T5008 down here is going to have lots and lots and lots of data that you're not going to be entering unless you know what you're doing. So what I will say is don't feel the urge to enter every single line. Just follow through. And if you're finding it complicated, use your textbook as a resource to remind you which data entry you have to do. So I'm going to do Investor's Edge. And then it's going to say Securities Type. And Securities Type, you have Other, which is the default, or Bonds or Treasury Bills. We are doing a Treasury Bill, so we're going to pick Treasury Bill. Okay. Recipient type, if you need a recipient type, it's going to be individual for this course. Okay. You're not going to be dealing with foreign currency. We don't have a box 14 in this case. We don't have a date of acquisition in this case, but we do have type of security, which is box 15, which you want to enter, which is debt obligations in bearer form. If you pick a different thing, you're going to get a different answer. So, for example, if it was shares, I'm going to have to do different data entry. If it was mutual funds, I'm going to have to do different data entry. A lot of this will automatically fill when you do autofill my return, but you will still have to make some decisions when you do that. So if I had left the other as a default, it's also going to give me different information here. I can take this out as well. We'll see what we get. I'm going to do Treasury bills now, debt obligations in bearer form. ID security, if you have a number of securities, you're going to put it in there. If you have a box 17, you're going to put it in there. I want you to remember your face value and your proceeds have to match. So we haven't given you a face value, but they have to match. Brittany, excellent question. How do you know it's a Treasury bill? Because box 15 says DOB. If box 15 says DOB, it's a Treasury bill. So that's your clue. And then you're going to check 19 and 21. If 19 and 21 match, you can do that data entry. If they don't match, you need to find a specialist who knows how to deal with a Treasury bill that did not come to maturity because there's special rules for that. But if 19 and 21 match, you're good to go. All you need to enter will be box 20 and box 21. And then again, if it's shared with other people, you can deal with that by splitting it out. Most of the time, if you see this, it's not common to see Treasury bills. They're not very, they're not in high demand at the moment. But if you do see one, you'll have to make sure that there are no additional attribution rules or other issues there. Most of the time, the investment is made by the person who has the money. So once we do a Treasury bill, I'm expecting to see interest going on the tax return. Let's see if it did. So I should have interest. And if it's not there, it means that I have missed something. Okay. So anytime that happens, what we're going to make sure is that you have entered everything that you need to enter. And my best way of doing that is to say, here's a section where, because it's not common and you have to do it all the time, use your textbook. Okay. So what I like about the textbook is it's going to tell you what you need to enter. And then usually it will give you pictures. So we should have a box 11, a box 15, a box 16, which we haven't entered, a box 17, which we haven't entered. We go back and put those in. Okay, 16 is 1. Let's see if I'm missing anything. Investor's Edge, securities type, Treasury bill, box 11, 15, 16, 17, 20, and 21. Now, I should see the Treasury bill there. So that's why I said you can put in everything you think you need to put in, and if it doesn't work, you're going to go back and you're going to look at your data entry again. This is where I want to show you that your resources are in your textbook. Okay. Now that I've done it, I want to make sure the interest makes sense. Is that the correct amount? Yes, it is. So if I take the proceeds and I subtract the disposition, it's there. I do not expect you to remember how to do this. okay? Especially because the data entry for T500 can change from year to year. So as investments change, lines will be added, lines will be taken away. They'll try to simplify the form. So what I am going to say is when you're entering a T500 for this course, I expect you to be going to your textbook and making sure you have everything in, and then go see if it's on the return. Don't enter extra things, but make sure you have everything you need. Any questions about this? So again, the tricky part here is if you don't do your data entry correctly, it's not going to make it on the return. If you think you've done it correctly, look at the return anyway. Just check. We've talked about the worksheet for the return. I want to add a few other things as well. I want to talk about adding in income that is not on a slip. So we'll do income that's not on the slip, we'll do carrying charges, then we'll take a break, then we're going to come back and do RSPs afterwards. I think that will get us to where we want to be. So remember, right now we've been doing a bunch of tax slips. I have forgotten one thing on my T500, which I should not forget to do, which is my double entry. I've done the entry, I've checked it's on the return, it makes sense, I've matched it with the slip, quality at source, check your numbers. And we have lots of income that's on a slip, including interest income on a slip. But remember that you can have income that is not on a slip that has to go on the return. Can you name some of the types of income that Lillian might have had that are not reported on a slip that we should be factoring in? Tips, which you've learned how to do. But if I'm thinking about interest income in particular, so interest and investment income, what kinds of things might not be on a slip that have to be added in? Interest from a bank account. Good. Interest from a bank account that is not reported on a slip would have to be added in as well. Okay. What about CRA interest? CRA interest has to be added in. In fact, when you ask her and you look into it, you find out that she did have CRA interest last year in the amount of $65.10. So we have to get that on the return somewhere. It needs to go into the interest section. So again, if you know your tax return, it makes the data entry easier. You might have a box for investments without having a T-slip. Isn't that nice? And would it be on the notice of assessment? Yes, the notice of assessment or notice of reassessment would have the interest on it. So if I go to investments without having a T-slip, I'm going to have a box there for interest. Interest is going to let me choose what I'm doing. So I might have interest from a Canadian source like a bank. I might have bond interest. I might have CSB bonuses, mortgage interest, interest from other sources. Okay. So in this case, it's not Canadian Sources Bank. It's going to be interest on any tax refund received notice of assessment. So if she had tax refund notice of assessment, I'm going to CRA interest. I might say which year the assessment was from. If there was interest from there, I'm at $65.10. Good. It's not a tax slip. I don't need a check mark for it, but I do need to make sure I've entered it. If I enter the CRA interest and I go to the tax return, I should be checking to make sure that it's going to show up in the correct place here as well. If I go to my worksheet, I should have interest on any tax refund. So when you're doing this data entry, just like we did by hand, you have to be careful to make sure you didn't put it in the wrong place. If I said income from foreign sources and the CRA was looking for CRA interest, it's going to go, oh, that's a coincidence that you had $65.10 from a foreign source, but I also know you had $65.10 from us, so I'm going to add it to that line. So make sure when you're doing your data entry, it's going into the correct place. Okay. Other places where you might have interest that has to go on there, you might have interest from a bank that's not reported on a slip. You might have mortgage interest. The keyword is interest, if you like that keyword, or if you go to the Smart Start, you're looking for the heading that says investments without a T-slip. Okay. Mortgage interest would go here. If I have foreign income, there will be a place for foreign income as well. We're not going to cover that in this course because it's complicated, but there is going to be a place for that as well. And then you might have a dividend that was not reported on a slip. It's rare, but if you do, you're going to say whether it is an other than eligible or an eligible dividend. If it's Canadian, you have to make sure that it goes into the correct place. So your data entry for those types of things will be here. That's rare, so I'm not going to go into it in great detail. Remember, everything in here is going to be Canadian source income. So this section will be Canadian. Okay, let me see if there's anything else that I want to add in. I think that was it. So yes, we do have the ability to have foreign investment income as well, or foreign dividends that are not reported on a slip. If that is the case, I would say go find a specialist because we don't cover it in this course. It gets messy when you get into foreign tax withheld. Okay. Any question about interest that is not on a slip? Mostly I'm going to say just be careful about your drop-down box. So if it's from a bank, make it from a bank. If it's mortgage interest, make it mortgage interest. If it's notice of assessment interest, CRA interest, make sure you have that. If you're doing an older year, you're going to notice the data entry looks different because we didn't have the breakdown in earlier years. So if you're doing an older return, it's just going to be interest and it's all going to go on the same line, and that will be correct. But for 2021 ongoing, we have this more complicated detailed schedule, so we have more complicated and detailed data entry. Right, and the very last thing that I want to make sure we have is carrying charges. So I have to get my carrying charges information because I'm going to add some there. Okay, so going back to our carrying charges section, our keyword for that is hard to find, but our smart start for carrying charges is easy to find because it's right in the middle of the deductions and you know that it's a deduction. So smart start will be there. If you remember, INTCAR charge is interest carrying charge and other investment expenses. We've done the management fees, but she could have had other things as well, and I'm going to tell you now that she did have an investment loan that she took out. She's still paying it back, and she had interest for that investment loan of $168.50. Assuming she did not use that to buy registered accounts, so she didn't use it to buy RSPs, which I'm going to tell you she didn't, we can claim that as a carrying charge, in this case, interest. Again, make sure you separate them out because these lines get audited and they have to go in the correct place. So I'm going to say investment loan interest. I'm going to say $168.50. I'm going to make sure that she has records of that, and she knows she's probably going to get a request for info to prove it at some point. And once I do that, we're going to go to the tax return now, and we should have, at the bottom of our worksheet, we should have our carrying charges as well, broken down into carrying charges and interest expenses, two separate ones, and a deduction, which will go onto the tax return. So we've added a whole bunch of things. What I would like you to do now is go take a look at the tax return and see if it makes sense. So you should have, employment income has not changed. We've added some of this specialized T4PS other employment income. You should have $4,800 there. We've added in quite a few dividends. The total dividends will now be $3,215.40. We have interest and other income from the worksheet, $2,933.25. Taxable capital gains, $189. Other income, $145. When we get down to our deductions, you should have carrying charges of $454. Other employment expenses of $2,760, sorry. And we're going to have that weird special tax situation, which is going to be showing up. We've got dividend tax credit, $482.95. We have our special taxes, $1,391.04. And at the very, very end of the day, she owes money. Does it make sense that she owes money? Absolutely it does. We've added lots and lots and lots of different sources of income that had no tax withheld from it. So she's going to owe right now $2,524.39. We're going to stop there. I'm going to take a break. I'm going to give you a break until, I'm going to say 11:08. And then when we come back, we're going to finish this chapter. Brittany, she might not be happy about owing. On the other hand, you're going to point out she made a whole lot of money this year. So if she's a regular investor and she's done this all the time, she's going to know about it. It's not going to be her first time. If it's her first time and she's really stressed about owing money, you're going to go, yeah, you owe $2,520. But let's take a look at what you did to your income, right? She took her income of $56,000 and she increased it by $10,000. So that's a good thing. It is a good thing to make money, but you have to pay tax on it. That's a conversation I have with my clients all the time when they're new investors. All right, so we're going to stop there, take a break until 11:08, and I will answer that question, Brittany, over the break. Breathe, stretch. We're going to come back. We're going to do RSPs, which is a little bit tricky, and then we should finish for today. Welcome back from break. Quick check mark, make sure everyone is still here, and make sure my audio is working. Both of those things are important. Excellent. So we have done the bulk of the investment side of things. We're going to do RSPs to finish up today, but I am going to say this isn't going to be all of RSPs. We're going to do the easy part of the RSPs. So we're going to do the sort of normal deductions. We're going to do the normal repayments of home buyer plan and that type of thing. That's what we're going to do today. We're going to come back like we did before and get into that really tricky RSP stuff where we're dealing with early spousal withdrawals, where we're dealing with transfers. We're going to be doing that in a chapter or two. So what I am going to recommend for the weekend, when you have time, after you've done your homework for today and you've done your practice problems, spend a little bit of time reviewing your RSP tax theory, because if you don't know your tax theory, you can't tell the computer what to do. So that's my best advice for how to prepare for next week, because when I go into it, the data entry is going to go pretty fast, and I want to make sure that you're not confused about why I'm doing the data entry that I'm doing. So that's my advice. Let's jump into the easy part of RSPs next, though. So this is going to be not quite so difficult. I'm going to see what I have in my textbook here. Going back now to my in-class exercise and find out whether or not we gave you this information. I have my notes. Yes, we did. So what we have here for RSPs is we have some contributions that she made, and we know her RSP deduction limit. And we're going to have some additional information. We're going to do this one piece at a time, and I'm going to do it in the order that I do it in real life, because if you do this every time, you don't make mistakes. So if you're going to do RSPs for anyone, the very first thing you're going to do is put the RSP limit in, because you need to know that before you do anything else. This will, of course, be available in your autofill my return. So when you do autofill my return, the RSP deduction limit will be something that you download. Unused contributions will usually also download. RSP slips are less likely to be there only because they come in after March, because you can contribute right up until March 2nd. So because you can contribute later, the banks have a longer time to send it to the CRA, then the CRA has to upload it. So we're very, very often manually entering in our RSP receipts. As I do the data entry, I want to set up a few things so that you know as we're doing this how to think about this in a broad perspective. So when we get into most clients, they will automatically have RSPs already selected because it's so common. And it's something that autofills for most people, it's going to be there. When you get into RSPs, we'll talk about T1 OVPs at the very end of class. If you have to generate a T1 OVP return to say that someone over-contributed, we'll talk about that very briefly. We're not going to do that today. That's going to be more complicated. But you're going to find in RSPs, you always have three options. I recommend you do room and limit first. Before you do anything else, make sure they have a room and limit. When you select room and limit, it's going to open up and you now have a blue star, because the computer is saying, if we're doing room and limit, I want to know what it is. Eligible room, you only have one option, RSP deduction limit for 2021. In this case, it is 12,476. Okay? That's where I start every time. We're going to come back to this section later. I'll show you a few things in this section later, but the first thing I want you to do before you do anything for RSPs is put in the room and limit, because if we don't know that, we can't decide what to do with it. The next thing we're going to do is decide what we want to do with the receipts. If you want the receipts to use up your RSP room, you're going to enter them here, okay? So when we get to transfers, we'll talk about where transfers go. Transfers will never be entered in the RSP section. They're always going to be entered in a separate way. Anytime you put a receipt in your RSP deduction section, you are telling the computer you want to use up RSP room for that. I'm going to revisit that later. I just think that's an important idea to have in your head when you come to it the very first time. So I know she doesn't have a transfer. I know she's made RSPs. She wants to deduct them. I have to use the room. I'm going to enter them here. I can choose whether I'm entering for her own plan or her spousal plan. If she had a spouse, she might have put money in a spousal plan. I'm going to check the receipts and see where she put it. She doesn't have a spouse, so we're going to choose own plan in this case. Okay. That takes me to my data entry, where I have the options of what she put it in. Now, if she had contributed to a Saskatchewan pension plan, anyone in the country can if they want to, but most often we would see people in Saskatchewan do that. I would put it there. RSP contributions are going to go under RSP contributions. You're going to see we have 3 options here. For today, we are not going to put anything in the memo field. That is only going to be used when we're talking about early spousal withdrawals. If you put something in the memo field, nothing will happen to it, because which tax year should that data have been entered on? If she made a contribution in January, February 2021, which tax year should we be doing our data entry in? (2020). Okay. So if you need to do data entry in 2020, you should be in the tax year for 2020 or doing an adjustment for 2020. So if we're going to enter receipts, unless we're doing a very specialized case where we have an early spousal withdrawal, we're only going to use March to December and January, February. We have an October date for the first receipt. In real life, probably not going to say October 31st on it. It's just going to say March to December. But in this case, she's given us maybe her statement, so we know it's October. I'm going to put 3,000 in, and then it's going to ask me who the RSP issuer is. I highly, highly, highly recommend you put in the name of the RSP contribution. And the reason for this is that some people have RSPs at multiple financial institutions. And I had this happen with a client who had a really complicated RSP over contribution scenario. And we were trying to track down all of her contributions for multiple years back. We went 6 years back in her case. And what happened was we didn't know which accounts were which ones. And so we had to make sure we had receipts from all of the different institutions that she was putting RSPs into. That's part of what caused her overcontribution, is each person wasn't checking her limit and they were maxing out as if she had the regular year's limit, and that means she was double contributing because each bank was putting in the maximum. So this way, when I'm looking at her file, I can say, oh, you had contributions to Royal Bank, and you had contributions to Sun Life, and you had contributions to TD Bank, and, so that if I have to get in that scenario, I can come back and say, now I need financial statements from all of these places for all of these years, so that I'm not missing any. All right, so we're going to put March to December, 3,000. We're going to put Royal Bank, and then we get a second drop-down box. It's going to open one more, and we're going to get to put in January, February, and that's going to be 1,000, and then I can put Royal Bank. And again, every time I create one, I can create another one if I have to. So maybe she also did a contribution in January, February to a different bank. She didn't. I'm just going to show you. I could then say Sun Life, right? Whatever the company is, and that will differentiate it. So I'm going to take that last one out because she didn't have it. And that's where we're going to put her current year's information in. And then if she had undeducted contributions, we're going to get this from Rep Client. We can enter in her undeducted contributions. And again, you're only going to use the keyword previous years, except in a very, very specific circumstance, which is going to be if we are doing a homebuyer plan repayment using January, February contributions. So unless you have that very specific scenario which require you to have done some extra research, generally speaking, you don't need to worry about it. You're just going to put undeducted contributions. If you download it from the CRA, if you look on Rep a Client, you're going to say previous years because you can't differentiate. If you do the extra research and there's a reason to do it, you'll use this field. But most of the time, we're just going to leave it as is. So in this case, it's 300. And that's it for her to start with. So before we talk about anything like a repayment, I want to show you what that does to the tax return. The computer will assume she wants to deduct all of it unless I tell it otherwise. So I have put in her room and limit. I have put in her receipts and her undeducted contributions. The default position is deduct everything. Even if it's not in her best interest because she's in a low tax bracket and she doesn't need it, it will deduct everything unless I tell it not to. So if I go to my Schedule 7 now, you're going to see undeducted contributions on line 1 where they should be, October contribution on line 2, which is where it should be, January, February 2022 contribution on line 3, gives me a total for the year, and then it's going to go down, check the limit, it's going to do the full deduction, and have no carry forward. So next year, no carry forward. This year, nice big deduction. What will happen to her refund or balance owing? She had a balance owing. What will happen if I take $4,300 off? It's going to make it better. It's not going to make it go away, but it's going to make it better. Okay. Now, that's assuming she wants to deduct all of it now. Maybe she has a reason to save some of it. So if she had a reason to save some of it, what could I do? That's where we're going to go back into our room and limit section, and you're going to see a line that says RSP to deduct. You can decide how much your client wants to deduct and how much they want to carry forward. So maybe there's a reason why she wants to keep that $300 undeducted. I would then say, oh, I want to deduct $4,000 and I want to not deduct $300. If I do that and I go to the tax return now and I go to my Schedule 7 now, you're going to see I have made some choices. Total contributions is the same. The limit is the same. Amount eligible to deduct is $4,300, but amount I'm choosing to deduct is $4,000, and I'm choosing to carry forward $300. It will do what I tell it to if I tell it to do the right thing. So if you have a reason, maybe someone has put a bunch of money into an RSP, but they don't need a deduction this year, and they're going to need a deduction next year, you can do that. And if you want it to be zero, if you want her to deduct zero this year, you can say, deduct zero, save all of it, and it will do that. If I carry forward $4,300 this year, do I have to worry about over contributions? What do we think? I have unused contributions. We're fine because she has room for it. What I do have to be careful about is if she keeps not deducting them and she doesn't increase her room, at some point, I might have to worry about it. But for now, we're fine. Undeducted contributions is optional. And Marisa asked a really good question. How long can you carry it forward? Pretty much indefinitely, as long as you have it. There will be a point when you can't deduct it anymore, or when you can't use it. And that does happen. We have some clients who put money into RSPs, and for whatever reason, they haven't needed it, and they haven't deducted it, and they never get the deduction because they never need the deduction, which happens. Okay. Most of the time, if we have clients putting money into RSPs, they're doing it for the reason they want the benefit, and they will deduct them eventually. I will also say, if you have clients, especially if they've been doing their own tax returns and they don't know how the software works, it's very common that we will find people who have undeducted contributions that they didn't know that they had. And if they have undeducted contributions they didn't know they had, and they're in a good tax bracket, this is the year when you're going to go, hey, you've got $3,000 of deductions just sitting there not being used. I'm going to use them this year, and I'm going to give you a nice refund for that. And then they're very happy with us. And Marisa, would a TFSA be better if they're not deducting? Absolutely. So if they're not deducting and there's no benefit for them putting in an RSP, they should put it somewhere else. Especially if they're putting money in that wasn't taxable and they're turning it taxable by putting in an RSP. So maybe they got an inheritance, they didn't know what to do with it, they put it in an RSP, they can't use the deduction. That's the worst thing you could do with that inheritance money, because you've taken money that someday will be taxed. When you take it out, you're going to pay tax on it, and you never get a tax break for it because you don't need a tax break because you don't have enough taxable income. That's not a good scenario. It's usually already happened. We can't do anything about it. But we should advise our clients in those scenarios, if they don't need RSPs, don't buy them. All right, so straightforward. She has RSP room. We've decided how much we're going to deduct. We're going to let the computer do the default in this case and deduct all of it. But in this case, she also has a home buyer plan. So again, I'm going to go a little bit slow here because there are some important things. Everybody makes the same mistake at some point, and I want to talk about that. For the home buyer plan, we need more information than I've given you here. When we put it in the computer, we need to know more details. So I'm going to give you those more details if I can find them in my notes. And I think there was one more thing that I wanted to show you, which is PRPP contributions. Yeah, before I do home buyer plan, I want to show you one more thing in here, which I will do in the textbook, because I think the textbook is really helpful on this. You're not going to see them all that commonly yet, but they're starting to become more common, which is pooled registered pension plans. So we're seeing some smaller employers where they can't afford a big formal RPP, which is a registered pension plan, and instead several small employers are coming together and creating a pooled registered pension plan. If you have a pooled registered pension plan, you're going to have something that is going to affect their RSP contribution room, and that means it needs to get into the tax return. So if that was going to happen, I'm going to show you what it would look like on her return here. I'm not going to ask you to do it, I just want you to see it. If her employer had a pooled registered pension plan, you're going to have a footnote on the T4 that's going to say pooled registered pension plan. This is a fairly new footnote, PRPP employer contribution. Let's say she had $2,500, okay? If she had $2,500, in that case, we would go to the tax return. And what I want you to notice when we get to the Schedule 7, everything is the same, but her room has now been reduced. That's why that number is important. It is going to change her RSP room now. The other thing that will happen for her RSPs, just so you're aware of how they happen, if she's paying into a registered pension plan, this $4,755 change to her registered pension plan is going to change how much room she gets next year. So her room will be lower next year because of this reporting number, but if it's a pooled registered pension plan, it's actually going to lower her income now. So if you have a client whose employer has a PRPP and they're asking you how much money I should put into my RSPs this year, and they're coming to see you in February, before you tell them your RSP room is $12,476, you want to say it's $12,476, but find out from your employer what they've put into your PRPP and subtract that first. Then whatever's left over is what you can put in. And Karina, is it like a group pension plan? Very much like that. So the idea is a registered pension plan is expensive for an employer to set up, and it is mandatory. They have minimums they have to hit every year. If they can't afford that, but they still want to have a pension plan for their employees, they can pool it together with other groups, and that's how you get a PRPP. It is treated differently. We haven't seen very many of them. It's just something to be aware of. So if you have a client who has that on a T4 and they're asking you for RSP advice, just make sure you're thinking about that. Okay. And again, that's something I wouldn't expect you to keep in the top of your head. I would expect you, on the other hand, to just remember there's a thing you have to look up and then go look it up. So I'm going to take this out. She did not have that. She had a registered pension plan, not a pooled registered pension plan, and everything is back to normal. All right, that was the messy one. Now we're going to do home buyer plan. For the home buyer plan, you're going to find a section of your data entry, and it's going to be HBP, and it's right underneath the RSPs. Do not confuse this with your home buyer amount. So HBP is your deduction related to home buyer plan, and then home buyer amount is going to be here. And also don't confuse it with withdrawals under the home buyer plan, because that's going to happen on a T4 RSP, which I will teach you later, but I will very briefly show you so you can see what it would look like. If she took money out this year, we don't need an HBP section. What we would have is a T4 RSP, and then we would have a withdrawal under the home buyer plan, and it would be a box 27, and you would say home buyer plan withdrawal, same address, and the amount would be in here. If I put that in, then I'm going to get a nice little Schedule 7, and I'm going to get my 24,700. I'll be teaching that formally later. I just want you to see home buyer plan gets handled all different kinds of ways. So the moment it's created, we're going to do an RSP receipt data entry. I'm going to take that out. After it's been created and now she has to pay it back, we have a new type of data entry, which I am going to teach you now. And that's where we're going to go into our Smart Start, and we're going to say home buyer plan, underneath RSP, select yes. You're going to notice lifelong learning plan works roughly the same. So if I open up my home buyer plan, it's going to give me a lot of options. Again, if you learn nothing else from today except this one thing, I want you to remember, never use any data entry except for government HPP information. If you are using anything else, it will not e-file, so don't do it. Every single time you're putting home buyer plan information in, you need to be using the government home buyer plan information. The other ones are there for when we're doing paper returns, because we can't access the CRA information because there's a major, major problem. So you should not be doing those ones. Government information only. I cannot stress enough how important it is. Your data entry is going to be completely different if you use the wrong one. So here we go. It's going to have some mandatory things, and I'm going to give you those mandatory things. Again, if I can find them in here, which I have. So what we're going to find out is that at some point in the past, and we don't need to know when, we can find out if we look it up, but she made a withdrawal of $10,500. And then we're going to find out that the outstanding amount, which is what she has left to pay, is, where did I put that? $6,300. And her required amount of repayment for this year is $700. Okay. So in this case, we need a withdrawal. Withdrawal is going to be here. We need an outstanding. We're going to have a blue star for the outstanding. That number they care very much about. I recommend putting the withdrawal in as well. It's not mandatory, but it helps you if you're going to be calculating if she wants to prepay some of it or overpay some of it. It's going to help you know how much is going to be left. And it just keeps track of how many years she's going to have as well. And then we have a red star, which is 700. When you do autofill my return, it will fill that in for you. So these AFR ones, you're going to leave those blank. Those get copied over in the autofill. But for our purposes, you must have a required payment. And that's it. So what we're going to do is leave it at that and see what happens. So we know she was required to repay $700. We know that she has put money into her RSPs. And what will happen in the computer is it will assume that she wants to repay the minimum. It assumes she wants to repay the required amount, and it will do that if it can. If there are RSP receipts in there, it will use them if it can. So in this case, we now have, out of our contributions, $700 being used as a designated repayment. and the remainder being used as a deduction, and we're good to go. Now, if she had not put the money in, so I'm going to change this to a 3, and I'm going to change this to a 1, and let's assume that she contributed $4 this year to her RSPs, and she had $300 outstanding. In that case, what would happen? She would get her undeducted contributions. She would have a $4 repayment because that's the only RSP she contributed this year. What would happen to the rest of the money that was supposed to be repaid? Where would it go? There it is. The computer will add it to income for you. Okay. So it will do that automatically. If there are no RSPs entered, it will put it into income. If there are RSPs but not enough, it will put as much as it can and then everything else into income. Okay. This is a scenario where maybe we would do a little digging and find out that some of those contributions were not from a previous year, but were actually from January, February of this year, in which case it would be able to use some of them as a homebuyer plan repayment, but you would have to investigate to make that happen. So I'm going to show you, if I changed it to January, February undeducted contributions, it would make them available for the repayment, but you would have to make sure that that's when the contributions went in the account. So we'd need to verify that on our receipts. If that wasn't the case, it wouldn't be an option. I'm going to put the 3,000 and the 1,000 back in, and I'm going to show you the last option that you have, which is what if you want to put a different amount? So it will automatically put the maximum or the required amount and no more, up to the required amount and no more. If I want to put none, if I want to say, never mind, I want the income, and I'm going to put new contributions in, I can choose designated payment. Designated payment, I get to pick whatever I want it to be. Now, if I designate more than she actually did put, the computer won't do that. I mean, if I say I want to designate a payment of $15,000 and she didn't have $15,000, it's not going to put $15,000. It's going to give me a whole bunch of warnings. And it's going to go, that doesn't make any sense, and it just won't do it. It'll do as much as it can, but I'm going to have to clear all those warnings. If I say 0, it will do what I told it to. It will say, designate none, deduct all of it, and then it will put the income where the income has to be. It will put it there. If I want to designate more, I can up to the maximum. So maybe she wants 1,000 this year. She wants 1,000 this year, and I know she had it. I'm looking at my RSP receipts. They're right there. I know I can put it in. Go ahead and do that. Put 1,000 in. Income goes away because I've put at least the minimum. I put more than the minimum. It's going to go in here, and it's going to say, oh, designate 1,000. Leave the rest of it. There's my new deduction. So I have control over what I'm choosing to do. Okay. It's going to be the same thing for lifelong learning plan. The data entry will be similar. I'm going to take this out. As always, if you don't need to do data entry, don't. If you want the default, let the default be the default. It's very easy to think that I'm going to put 700 in and hit my tab key a little bit too fast and create a problem for my client. So if I don't want to do that, if I want it to be the minimum required amount, just leave it. Okay. Lifelong learning plan is going to work the same way. It's going to be government information. You need the withdrawal, total withdrawal, the balance owing, the required repayment, and then if you want to change the amount, if you want to designate more or designate less, you can choose it here as well. So the data entry will be the same. I will take that away so that I don't have a red star. And then if you have someone who has put money into an athletic trust, all I'm going to say about that is there's a section in your textbook about athletic trusts, contributions to an athlete's trust. They are so uncommon. If you need the data entry, it shows you how to do it here. Okay, so that is investment income. You now should know most of what you need to do if you want to practice extra for some of those early practice problems, you did chapter review problems. You are going to have quite a few review problems in this chapter as well. So we have 4 problems in this chapter, and you should be able to do all of them. I'm going to be adding in some additional information, which I will find and put up on the screen here. And one thing, again, I want to stress is for practice problem 10-2, Doug Nielsen had social assistance, and we're in Manitoba, so you need a box 14. I have calculated what the box 14 would reasonably be. In real life, it's going to be on the slip, and you're going to take what's on the slip. But for the purposes of this class, I would like you to enter a box 14 as well so that you're practicing it correctly. That's going to be important because when I teach you additional provincial credits, I'm going to come back to that file and let you see what the effect of it is. So make sure you've entered that. As always, I'm going to give you more information. So we're going to have, oh, it says 10-2. It should say 20-2. I apologize. When I give it to you, if it's already been sent out, it'll be wrong. I did do that portion of it quite late at night last night. So there it is. So as you're going through, it's going to give you lots of line numbers to check now, lots of schedule line numbers. So if you see one that says schedule 3 and it has a line number, go to your schedule 3, look for that line number. I'm going to be asking about data entry lines. As always, data entry lines, I'm talking about lines with $ numbers on them. So where do we have $ numbers? And then check marks and notes. You're going to notice when we get into investment income, you're going to be dealing with notes for balances owing. So make sure you're thinking about what's adding to the taxes owing on the bill, what hasn't had tax deducted from it. One more thing I want to show you, which is in the book but a little bit hard to find, is the scenario where you have someone who has already signed up for online mail and you don't need to sign them up again, but you want to make sure that it reflects correctly that they've signed up for online mail. So I'm not going to use Lillian for this because Lillian doesn't have an email address, but let's go back and find a client who does have an email address. And I'm going to go into, let's say, Betty Robinson again. So I'm going into Betty Robinson. She had an email address. If she was signing up for online mail this year, I would say email conditions yes. And if I said email conditions yes, I'm going to set up an e-file information so you can see what it looks like. When she signs her e-file authorization, it would say, I'm registering this year. And that's what we want it to be. And on the first page of the return, you already know this, it will have an address there. But what do I do if she signed up for it last year? So if she signed up for it last year, I don't want to say yes because that would mean that she is signing up again. And you don't want to sign up again. If she's already registered, you want to leave it the way it was. But if I leave it off, then it's going to say she wants paper mail, which is not what she wants. We want to get this box here. We want that I want my electronic filer to receive a one-time notice, and I have already signed up. So I have already done this, okay? And in that case, we're going to go in and we have a new keyword, which is my account. If you go to keyword, my account at CRA, you're going to have an option, which is my online mail. If you have a client who's already signed up for online mail, you're just going to say, already signed up for online mail. You don't need to enter an email address again. Just say already registered. If I say already registered, it should, and it's not going to do it because it's a student program. The student program is a little bit buggy. But what it will do is it's not going to put anything here, but it will confirm when you file it with the CRA that they are going to receive things electronically. Okay? And that will work on the actual program. So that's what you have to do if they have signed up in a past year. I'm going to show that to you one more time because it can be hard to find and you have to know what you're looking for. So if I delete that and I take the keyword out, delete that one, and I take the keyword out, should go away in a minute. There we go, and now it's gone. The keyword that I'm looking for is my account, or underneath accountant, you're going to find the My Account button. My Account online portal is going to confirm information that your client has already set up. You need to manually go in, say My Account at CRA, and you need to say Online Mail already registered, and then you need to leave it alone and don't put anything else in. And that's it. So that is in your textbook. It's hard to find. If you can find the page that that's on, I would highlight that one. This is still new data entry, so I will say even experienced associates in the office have a hard time finding this particular bit of data entry, so it's a good one to practice. And you're going to have to do it for one of the practice problems. All right, I think everything else I have done. As usual, I'm going to be asking you for some questions. When you get to the Reginald Morrison case, I'm going to be asking you where Reginald's dividend income came from. When you get to the Simons case, I'm going to ask you a whole bunch of questions about medical expenses, where you should do your data entry, what other questions you might ask. Every time I say other questions, assume I mean provincial, because otherwise it would already be in the case. So when we get into some of those, I want you to start thinking outside of the confines of the case and put it in the real world. You're going to have some families, so you're going to have to decide how many returns you're creating. You're going to have to decide how many files you're creating in the computer. All of those things. So it's a good one to practice this week. You have lots of time. I'm going to stay for the next part of class. If you want to get practicing now, start on the first one. You're scheduled for class time until 12 o'clock, and then if you run into a problem or you want to review it, I will be right here. Or if you have questions about anything, theory questions, anything like that, let me know. Otherwise, I will say have a really good weekend, and I will see everybody next Monday.